Okay, let's dive right into this explainer. I want you to imagine planting a tiny little tree right in your backyard. Every single morning, you walk outside and you measure it. One day, it grows maybe a millimeter. The next day, absolutely nothing. A week later, a storm rolls through and actually bends its branches. You're looking at it, getting incredibly frustrated, and you think, man, this tree just isn't growing. So in a fit of total impatience, you cut it down. But here is the kicker. Fast forward 5 years, and your neighbor's tree, which they planted at the exact same time, is now towering over the entire neighborhood. The difference wasn't better soil and it wasn't better seeds, it was literally just patience. Well, the stock market works in that exact same way. Market growth requires immense patience measured over years, not days. Which leads us to a kind of crazy question when you really think about it. Why do we measure daily what takes years to grow? It is such a fascinating human tendency. We judge these massive long-term wealth-building engines by chaotic weekly or even daily fluctuations. I mean, so many people will judge their entire financial future by what the market happens to do this Tuesday. But the real truth about stock market growth, you can only see it when you zoom way out over the years. So today we're uncovering the reality behind one of the greatest wealth-building machines ever created, and why zooming out is absolutely your greatest asset. So let's meet two guys, Alex and Noah. Both are 28 years old, both earn pretty similar salaries, and both are chasing that dream of financial freedom. One evening, they both decide it's time to start investing. Now, Alex is super action-oriented. He just starts investing consistently in a diversified index fund. Noah, on the other hand, lets fear totally take the wheel. He's like, you know what, I'll wait indefinitely until the market looks a bit safer. He hesitates, basically just sitting on the sidelines waiting for that perfect, magical moment. Well, boom! A few weeks later, the market falls by 10%. Noah smiles. He is feeling completely vindicated. I knew it, he says, watching Alex's investments suddenly drop in value. But Alex? He remains completely calm. He doesn't panic. He doesn't scramble to hit the sell button, and he certainly doesn't regret his decision to get started. Why? Because Alex remembers one fundamental concept that completely escapes most short-term thinkers. And that concept is absolutely crucial. Price and value are not always the same thing. Actually, I want to say that one more time because it's just that important. Price and value are not always the same thing. This is the foundational lesson that keeps Alex from panicking during sudden market dips. Just because the price of something drops on your phone screen on a random Tuesday, that doesn't mean the actual underlying value of the asset has just vanished into thin air. Okay, moving into section 2, the mechanics. What are you actually buying? You know, a lot of people think a stock is just a 3-letter ticker symbol or some glowing red or green number on a trading app. But I want you to imagine walking through a giant shopping mall. Instead of clothing stores, every shop is a massive, real-world business. One store belongs to a tech company. Another sells cutting-edge medicine, another literally builds airplanes, and another delivers food. The stock market is really just a place where people buy and sell ownership in these exact businesses. When you buy a share, you are not buying a number on a screen. You are buying a tiny piece of a real, functioning, breathing company. If that business grows over time, your investment has the opportunity to grow right alongside it. Which brings us to section 3, the conflict, volatility versus impatience. Think back to our tree from the beginning. Or better yet, imagine a farmer. Picture this guy going out into his field every single morning, literally digging up his crops just to check if they've grown yet. I mean, it's totally ridiculous, right? Because every single time he digs them up, he is completely interrupting the growth process. Yet a lot of investors do something remarkably similar. They check prices every hour. They react to every single breaking news headline. Buy, sell, repeat. They are obsessively digging up their own seeds and interrupting their own wealth compounding. Meanwhile, the really successful long-term investors do something way less exciting. They just let time do the work. So we really have to understand this exact definition. Volatility is simply the price investors pay for the opportunity to earn higher long-term returns. Imagine standing right next to a roller coaster. Up close, it is totally chaotic, whipping up, diving down, upside down. The news channels love to zoom in on that and scream, "Markets in chaos." But when you view that same ride from a distance, the entire coaster still safely reaches its destination. Short-term movements are entirely unpredictable. Volatility is completely normal. It's the price of admission, not a permanent failure. The absolute biggest mistake you can make is confusing a temporary decline with permanent failure. Let's apply some basic Main Street business logic to your portfolio here. Imagine you own a small local bakery.
Some days it's totally dead, right? Other days the line stretches around the block. Would you sell your entire bakery simply because one slow, rainy week reduced your sales? No way. No sane owner is going to sell a perfectly good business just because foot traffic was down for a few days. You'd focus on whether the business continues improving year over year. Well, guess what? Investing works the exact same way.
So there is this stark contrast between these two timeframes, and it's a real game changer once you get it. Daily stock prices reflect emotion, while long-term value reflects business performance. You have to learn to tune out the emotional, noisy daily price tags and focus squarely on the underlying business. These companies are out there creating more products, solving bigger problems, and earning more profits over time. That actual business performance is the engine that truly drives long-term value.
Section 4, the resolution. Let's talk about the invisible engine of growth.
Let's look at this timeline through the eyes of Alex's grandmother, Rosa. Rosa has this old drawer just stuffed full of faded investment statements from decades ago. When she first bought those, people told her, "Rosa, the market is way too risky right now." And just look at the history she actually lived through. The 70s? Massive oil crises. The 80s? Brutal economic recessions. The 2000s saw massive financial crashes. And obviously, the 2020s brought a global pandemic. Wars, political chaos, the terrifying headlines change every single decade. But as Grandma Rosa knows, sure, the headlines changed, but great businesses just kept adapting. The world is always changing, and successful companies figure out how to change right along with it. We can actually see how this builds using a really simple metaphor, the invisible engine. Imagine you own this machine. In step 1, it produces just one product every hour. But by step 2, a team of engineers comes in every year and tweaks the design. It gets better, so now in step 3, production doubles. It goes to 2, then 4, then 8. This perfectly visualizes how compounding innovation is what actually drives long-term market growth. As businesses get smarter and more productive, their value can increase exponentially over long stretches of time. And let's ground this engine metaphor in the real world, because this isn't just theory. The real-world engine is made up of companies actively inventing breakthrough medicines, creating cleaner energy, building incredible technology, and totally revolutionizing transportation. They are out there right now serving billions of customers and creating immense value. That is the invisible engine powering your investments. Its business is growing, economies evolving, and human innovation stubbornly continuing to march forward. So let's fast forward 5 years and check back in on our two friends. You can see the completely stark difference in their outcomes, and it's based entirely on their mindsets. Alex's habit was just buying consistently, letting time do the heavy lifting. Sometimes the market was high, sometimes it was low, but he didn't try to predict it. He avoided waiting forever for that perfect time. And Noah's habit? He just waited for predictions. He read articles saying, "Oh, the market looks a little expensive right now," or "Maybe let's wait till next month." Years passed, and for Noah, hesitation just became a permanent state. Waiting completely paralyzed him, while Alex's boring, consistent discipline set him up for total success. All right, bringing us to the final section, the takeaway, climbing the mountain. Imagine you are climbing a massive, rugged mountain. The path up a mountain is never a straight line, right? It has upward climbs, sharp downward slopes, and totally unpredictable obstacles you have to hike around. If you only look at your last 50 steps, especially if you're on a downward slope, you're going to think you're going completely in the wrong direction, or just going nowhere at all. Judging your progress by the last 50 steps will make you feel completely lost. But reaching the actual summit requires enduring those downward slopes without turning back in panic. Because when you finally get to the top, you realize that every single step, even the really painful, frustrating ones, was necessary to reach your goal. Investing feels exactly like that unpredictable climb. So the absolutely crucial point here is this. The stock market has rewarded patience far more often than prediction. The market is not a fast, smooth ride, and nobody can predict it in the short term. It's not a lottery ticket, and it's definitely not a casino. True wealth comes from staying invested in quality, diversified assets through the great years, the terrible years, and literally everything in between. People always think successful investors somehow have a crystal ball. They don't. They just understand that giving it time allows innovation and growth to compound. So, I want to leave you with a provocative thought to wrap up today's explainer. Stop asking yourself if the market is going to go up tomorrow. It's the wrong question. The much better question to ask yourself is, where could disciplined investing take you over the next 20 years? Because true wealth isn't built by predicting tomorrow's terrifying headline. It's built by staying committed long after those headlines are completely forgotten history. Think back to that tiny tree from the beginning.
Sometimes the absolute greatest advantage you can possibly have in investing is simply having the patience to let time do its work.